Hello and welcome to Options Guy TV. Today we have a special treat for you. We're going to talk about the top 10 mistakes that option traders make. We're going to do this in a two-part series. So today is going to be part one of the top 10 mistakes that we want to avoid as option traders. So we're going to go through mistakes 1 through 5. So it's going to be a short and sweet, probably about a 30-minute presentation today. And we're going to cover a lot of things. And we're going to start out with kind of the basics, the beginning option trader mistakes. That's where 1 through 5 kind of live in that space. So to start with, I want to go through the 4 basic positions that we have in when we're trading options. So if you look at the 4 basic positions, what do you have in the options trading world? You have the buy of a call option, which gives you the right to buy stock at a specific price for a specific time period. Now, once you buy that call option, you are considered long that option contract in your account. And what's very interesting is a lot of people, when they first come into the options trading space, they think about, oh, I want to speculate on options and get rich quick. But options, that's not what they were first intended for. Options are a way to protect an asset more than anything. So when I think about a call option, if you think about the opposite side of the coin, where you're the seller of an options contract, it's a little bit easier to understand why they call it a call option. So if I buy a call, I have the right to buy the underlying stock. It's going to be normally 100 shares of stock. But if I sell a call, I take on an obligation to sell you that stock. In other words, people can call stock away from me. And that's where the term comes from. Once I sell that call, I get paid. And for that premium that I receive for selling that call option, I take on an obligation. And that obligation is going to be to sell that stock at that strike price, which is going to represent 100 shares. Once I sell a call option, I'm considered short that option contract in my account. So when you think about the need to protect, you think about insurance, your mind goes to that right away. And sometimes they'll call the seller of an option contract the writer of the contract. And that comes directly from the insurance marketplace. If you are selling an insurance policy, you are often referred to as the underwriter of the contract. So if you think of options from that aspect, it's a little bit easier to understand the vernacular, in that we have 2 flavors of options. If you are the seller of an option contract, so that means somebody bought that option contract from you, and they have the right to call stock away from you at that specific price. If I'm going to buy that stock at a price, that means that I want the stock to go up because I'm buying stock, and hence I'm bullish on the marketplace. Now, if we go to the other side of the coin and we talk about the puts are always kind of hard to understand, or even hard to ask questions. And the main reason why is that if you buy a put, that means that you have the right to sell. So buy means sell with puts. And once again, if you think of where options come from, they're kind of all the terms and all the things that are involved with it come from the sell side of things. If you sell a put, you take on an obligation to buy. So that means that people can put stock to you. And that's where that term comes from. Once again, if I'm a seller of a put option, I'm often referred to as the writer of that option contract. But if I'm buying something with the intention of selling stock at a later date, that means that I'm going to be bearish on that marketplace. So if I buy a call, I'm bullish. If I buy a put, I'm bearish. And if I sell those option contracts, if I sell that call, it's going to be the opposite, right? If I buy the call, I'm bullish. So if I sell it, I'm bearish. And if I buy the put, I'm bearish. So if I sell it, I'm bullish. And it's really that straightforward. But all option trading strategies are built from these 4 very basic positions in the options trading world. So I always like to start off kind of a basic presentation, which I think part 1 of the top 10 mistakes 1 through 5 are going to focus on. And And a lot of people always think of options as a leverage tool as opposed to a tool that can be used to enhance your stock portfolio or protect your stock portfolio if you would like. All right, so let's get into mistake number one. And this is 100% based on beginning option traders. And the most common mistake that I see is people come, usually I used to work at the Chicago Board Option Exchange, which is now called SIBO Global Markets. And they've always, all the research that they did, most people will usually buy stocks before they dip their toe in the water to option trading. So if you think of that, almost everybody has owned the stock before they trade the options. They come into the options marketplace and they know that if they buy the stock, they want the stock to go up. And so it's very simple, very straightforward. You don't want to pay a lot of times they do stock splits to lower the stock price to make it feasible for people to be able to buy 100 shares of stock. Well, in the options trading world, most option contracts, 99% of them represent 100 shares of stock. All right. So you have the right to buy 100 shares of stock. Well, if you look at the quotes for the option contracts, you look at an option chain that shows all the prices and a specific expiration. Well, why not buy the cheaper option contracts, right? There's a plethora of them that are available. So the cheaper option contracts in a specific expiration are usually going to be the out of the money option contracts. And calls are easier to understand than puts. So that's all right. You're bullish on a stock. What's the first trade that a lot of beginning option traders like to make? They like to buy out of the money call options because they think the stock is going to go up. Why are they buying the out of the money one? Because they can, right? They're cheap. You can buy a lot of them. You sound great at a cocktail party. Yeah, I own 100 of these Apple call options, right? Sounds good. Nothing wrong with that. But bottom line is you need to understand what you are asking the stock to do when you buy an out of the money option contract. So really mistake number one might be not realizing how option prices move relative to actual stock prices. So we're going to go through a little reindeer game. I'm going to spend more time on mistake number one than any of the next four mistakes here in this presentation. But if you look at our PowerPoint slide, we say to start off with buying out of the money calls is the hardest way to consistently make money. Now, I get a lot of pushback. I get people that have traded options. Oh, I bought an out of the money call and I made X amount. Yeah, if you're correct on your forecasts, yeah, there's no worries. And there is a time when buying an out of the money call option is the right thing to do based off of your bullishness on that underlying stock. But if you're starting and you're only buying an out of the money option because it's cheap, you need to learn a little bit before you continue to trade option contracts, right? So if you're buying an out of the money option contract, here's the bullet number two. Success requires predicting both stock direction and timing correctly. And that's hard to do. So you can be right on direction, but you know what? If it goes after the expiration date, all of a sudden you get the move. Well, it doesn't do you very good on your option contract. So you got two things that you got to get right, as opposed to just getting one thing right if you buy the underlying stock. And then next, cheap options are risky due to rapid time decay and low probability of profitability. So in this third bullet, we're going to focus on this term probability. If you think of option contracts, it's always about the probability of the stock reaching that strike price, right? The further you go out of the money, the lower the probability is, means the lower the price will be. So it is the holidays when we're taping this. So I decided to call this my reindeer game as my example. So let's set up a scenario. We have just XYZ stock. We're going to, the company does not exist, but the stock is trading at $50. We have a 90-day. This is all theoretical, but all these prices were put together with an option pricing calculator. So in the theoretical world, the 90-day 55 strike call is trading for $1. So the stock is at 50. We are definitely buying an out of the money option contract because we're buying the 55 strike. So the stock is at 50. The 55 strike means we have the right to buy stock at 55, 5 points above where the current market is at. So that's an out of the money option contract. All right. So we look at this option. We're bullish on the stock. We decide we're going to buy this. We got 90 days to expiration, and we pay $1 for it. We can buy a lot of them. Each contract represents 100 shares, so that's $100 per contract, and we're controlling 100 shares of stock, and we have the right to buy the stock at $55 anytime between now and 90 days from now. So the stock, let's say we're correct on our forecast. We're a good stock picker, and 45 days go by, and our stock goes from 50 to 52. It went up $2.50. That's a pretty good move. That's a decent move on that underlying stock. So my question to you now, and I'm going to give you a couple of seconds to ponder this. What is the 55 strike price call option trading for now? What do you think the value is? You bought the 55 call. You paid $1 for it. The stock went up 2.5 points over 45 days, which means you have 45 days remaining in the life of your option contract. What do you think the 55 strike call is now? Put a number in your head. Play in my reindeer game. The answer is that it's trading for $1. Now, in the theoretical world, we're not talking about interest rates moving. We're not talking about fancy things like implied volatility. Nothing changes. All that happens is that the stock goes up 2.5 points and we get 45 days worth of time decay. Now, the answer is 1, and there's a simple answer for it, is that the probability also didn't change, right? So to start with, we were hoping that the stock would move from 50 to 55 to get to our strike price, basically. And if you do the math on that, 5 points on a $50 stock, that's a 10% move. In the stock world, 10% is just a solid return over a year period, let alone a 90-day period. So with that, when you're thinking about that, first of all, you're asking the stock to do a lot. The stock then did move, but it moved 5% and it took half the time. So if you think of option pricing and strikes on out-of-the-money options in particular, you're thinking about probability. What's the probability of the stock reaching the strike? Well, the probability didn't change, right? You needed it to go 10% in 90 days. Now you need it to go 5% in 45 days. So what I'm saying is when I go all the way back to bullet number 2 on the slide, success requires predicting both stock direction and timing correctly. Well, you got the direction right, and you're actually not doing bad on the timing, but you're not doing good enough. If this stock would have moved within the first 5 days of the life of the option contract, you would have done better. If it was the last 5 days, you'd probably be out of luck. You'd probably lose almost all your investment because the option would be way out of the money relative to the stock with very little time remaining. So the option might have been trading for next to nothing. So keep this in mind if you're buying out of the money options. You got to be very bullish on the underlying stock. There's a time and a place for it. But beginning option traders have a tendency to buy out of the money options just because they're cheap and not realize what you're asking the underlying stock to do in order to be profitable on it. And then, you get a bad taste in your mouth because you were right on direction and you might have lost money by being correct on your forecast. So the way that I like to look at it is how can you trade smarter? Now, you can talk about buying an at the money or an in the money option contract. That's a little bit different scenario. But what I would like to see you do, if you're a beginning option trader, and I've already mentioned most beginning option traders at least own some stocks, have stocks in their portfolio. And the strategy that I would like to see you do in this scenario, as opposed to buying that out of the money option contract, is actually sell a covered call. Actually go out and say, let's keep the same scenario. Let's say the stock is at 50. You own 100 shares of stock at 50. Let's sell that option contract saying that you will take on the obligation for them to call the stock away from you at $55, 10% higher. And for saying that you will sell your stock at that rate, at that price, $55, which would also be referred to as a strike price, you receive $1 now saying you're willing to sell your stock higher later. And that can be done with a limit order. A lot of people will put limit orders above the stock price and say, go ahead. If it gets to that level, you can sell my stock at that price. So it's kind of similar. There's a little bit more nuances. And then the second round of mistakes 6 through 10, we will talk a little bit more about the nuances of selling option contracts and the obligations that are involved. But to start with, that's the covered call strategy. And that is the most popular strategy. I've been teaching options for 30 plus years now. And that is the most popular option strategy that is out there. A lot of people think it's just buying call options, but a lot of people just like to bring in income above and beyond any dividends for just saying they'll sell their stock higher at a higher price overall. So pretty straightforward on that. So that's mistake number one. And now we're going to go to mistake number two. If you do have questions, you can put them down below the video. Don't put them in the chat box. Put them down below because this is being taped at this point in time. And we'll look at them. We'll try to address them for you. But let's get to mistake number two. And this kind of goes hand in hand with mistake number one, talking about the leverage factor in options and why people are drawn to option trading in general. Is you need to understand that leverage factor. It's an important thing. You don't want to take all the money that you were going to use to buy your 100 shares of stock at 50 and buy as many call options as you can with that $5,000, which is 50 times 100, and risking all of that capital. Because as we said, if you're doing especially out of the money option contracts, you need that stock to get to that strike. And if it doesn't, and go beyond actually, because you're paying for the option contract, you could lose your entire investment. And that's the scary thing with beginning option traders. Okay, so a question, and I'm going to point to bullet 2 because I kind of covered bullet 1 already, but a question is the outright buying of calls a speculative or a conservative strategy? So here's your second question for the day. Is buying out of the money calls a speculative or a conservative strategy? And it's kind of a trick question because the answer is that it's both. It's all about how you approach it. So I'm going to change things up a little bit. We're going to go a little bit away from the 50 strike call option. And what we're going to do is, let's say the stock's at 60, just so that we don't get confused. And we have two people that are looking to buy option contracts on this underlying stock. Stock is at 60. We're going to look at buying an at the money option contract. That means we'd be buying the 60 strike. And we'll go out 60 days in this situation instead of 90. That option contract, in theory, using a theoretical pricing model, once again in the theoretical realm, might be trading for around $3. That means that for every option contract we buy, we're going to pay $300. Now, if you look at buying the underlying stock at 60, 100 shares of that would be $6,000. So let's talk about person number one. Person number one is thinking, I'd like to learn about options and I like this underlying stock. So instead of buying 100 shares, I'm going to buy something that represents 100 shares. I'm going to buy one call option at $3. That means I'm spending $300 on that call option, but I have the right to control 100 shares. Now, if I do that and I buy that one option, do you think if I had bought 100 shares that the stock could go down by more than 3? Yeah, definitely. It could go down 4, 5, 6. That's very possible on a $50 stock. And if I do that over the next 60 days, right, I would be losing more on the stock than I would on the option. So the option provides me or gives me a protection against the opportunity of the underlying stock taking off. So I'm thinking about buying the stock. I'm a little nervous about it. I go out and say, well, I'm going to buy one call option. And if I go out and 10 days from now, the stock's trading at 65, well, I'm going to be happy because I didn't buy the stock. You know, I'm a little sad that I just didn't buy the stock outright, but at least I bought an option contract and I got some representation of the underlying stock movement. Now, person number two, if you're thinking about the leverage factor, comes in and says, well, I could buy 100 shares of stock at $6,000, but it's trading for $3 an option contract. I can buy 20 option contracts. Why don't I want to buy 20 of them? Well, in that situation, you're using all your capital to buy as many option contracts as possible. And if the underlying goes down instead of up, in that scenario. And let's say it goes down $4, like we mentioned in the first example. And at expiration, it's $4. Well, guess what? You just lost your entire investment. But if you own the stock, you would only be down $400. 100 shares times $4 if the stock went down that amount. So you really need to think about the leverage factor. So how can I trade smarter? Here's the way I look at it. And this is, once again, focused on beginning option traders. If you are thinking about buying call options, and we talked about how scary it is to buy out of the money option contracts. So now if I'm going to buy an at the money contract, or even a little bit in the money, something that's got intrinsic value or real value, if I would normally buy 100 shares, buy one contract. If you normally buy 300 shares, buy 3 contracts, or maybe try 4. I don't know, but don't go overboard on the leverage thing. Don't go at all overboard on the leverage thing. So that is a situation that you got to be aware of. And this is the second most common mistake is we buy the option contract, and then the market, the first thing is drawn to the out of the money option contracts. And then the second situation is buying too many of them and not really realizing the risk that all that leverage makes. Now, you get it right. Well, yeah, you're going to do well. And some people do very well and do get that direction right. So if you do, by far, an out of the money option contract is the best trade. If you know for sure that stock's going to go beyond your strike price, beyond 55 in our first example, then yeah, you want to buy that option contract, and you're hoping that it's going to go way beyond it. And that's kind of the outlook. All right. So that's mistake number 2. Let's now look at mistake number 3. Having no defined exit plan. When trading options, just like stocks, it's critical to control your emotions. But a lot of people always kind of have this attitude: what if I get out too soon and I leave some upside, or the market's going down? Oh gosh, but the Fibonacci ran into the Bollinger Band, and the RSI is saying that we shouldn't sell right now. It's just really weird, the excuses that I hear from a lot of adults, and I use with quotations, right? That is their excuse for not getting out. Yeah, you've lost some money. Get out, move on, especially in the options trading world, because you got time factors that are involved. So it's really simple. Get your plan and stick to your plan. And that's another thing. It's okay to have a plan, but don't just exit the plan. And I have a little bit of a joke here. It's pretty straightforward. Make a plan and trade your plan. That's very straightforward. That's how you trade smarter. But if you're feeling the urge to not follow your plan, here's my advice. Lay down until that urge goes away. That's simple. Just take a pause. Say, what was mistake number 3 of Brian's presentation? Oh, that's right. Stick to your plan, and then go back and do your plan. I feel like in my history of option trading that some of my best trades were trades where I didn't want to get out, but I still did. And I saved myself from a catastrophic loss because the market wasn't going the direction I wanted it to. And even though I think it still should have went that direction, it wasn't. So I got out of the trade and I saved myself. And that's a much harder trade to accomplish and pull off than it is to pull off a big winner and just hit the sell button and close that trade. All right, that's mistake number 3. So mistake number 4, realize that in the options trading world, you're not trading stock. So the concept of chasing losses by doubling down. And once again, this all goes back to kind of buying out of the money option contracts. So realize that option prices behave differently than stock prices. And I proved that in mistake number 1 in our reindeer game that we put together. So stock strategies often don't apply to options. So be cautious when you're thinking about this. For example, doubling up to catch up typically doesn't make sense for option traders. Doubling up to catch up, right? So you think about stocks. Well, you like the stock at 50. Well, it's now trading at 30. You gotta love it now, right? It's $20 less. Heck yeah. Let's double up to catch up. So I go in, I own 100 shares at 50. The stock goes down to 30. I still like the stock in theory, we're saying. So you buy another 100 shares, and now your cost basis is 40 on 200 shares. And that's okay. That's not a bad strategy if you actually like the stock. And maybe it got blindsided, it got beat up a little bit more after their earnings than you think it should have. And so I'm going to double up to catch up. Well, in the options trading world, in particular, buying option contracts, that option contract is probably now out of the money. So you bought an at the money option, the market went down. Just don't go and buy that same option contract to double up to catch up. It just doesn't really make sense. And here's the way I think about how to trade smarter. It's this the half bullet here, if you will, bullet 1.5. Is this a move I would have taken when I first opened this position? Would I have gone back in and actually bought this out of the money option contract? And if the answer is no, just don't do it. Probably just exit the trade. Most of the time in that scenario, once again, you have a plan. You're probably down on that plan, or you're down obviously on your position. So close the position. Move on. Go find another stock. It's a much different outlook. If you're trading, especially shorter term options, and I think a 90-day option contract is shorter term. Nowadays, they have 1 day, 2 day, 3 day option contracts, right? Almost every expiration is available, in particular on a lot of the indexes. So, and ETFs that track indexes. So with that said, that's a good question to ask. Would I have done this to start with? Am I panicking here? Maybe I should just close the trade and move on. Cut losses, shift focus, avoid larger losses later. Options provide leverage, but be mindful of the deeper risks. There you go. So now we're coming to mistake number 5, trading illiquid options. So now this one's a tough one because you do all your research, you look at your chart, maybe you're doing technical analysis, and then you add in some fundamental analysis, and you find the perfect stock. And we're going to call it consolidated widgets, right? Made up stock. But they just announced that they got a new AI platform. They're going to buy an NVIDIA chip, so that obviously the stock's going to take off. And you go and you look at the options contracts, and you see that they have a very wide bid-ask spread. The difference between the bid price, which is the price that you're selling at if you're a retail trader, and the ask price is almost, let's call it 50 cents wide, or on a percentage basis, it's 20 or 30% of the actual price of the underlying stock. Well, not of the underlying stock, but of the option contracts that you're trading. And if you're looking at that and you get into that scenario, once again, you don't want to trade those options. So when you're trading options, you're usually staying to very liquid names, the Magnificent Seven, or the SPYs, which are the S&P 500 index ETF, the ETF that tracks one of the most liquid underlying ETFs in the world, honestly. So if you look at bid-ask prices and they're really wide, there's no really good answer for that. You might want to just buy the stock and not trade the options. It's hard to get direction right. And if you're paying too much to get in and out of the position, that is an issue. Now, you can always work to trade to get in, and that's fine. And once again, if you're correct on your forecast and the market goes up, well, you can work the trade to go out. But the situation where the situation is scary with wide bid-ask spreads, illiquid option contracts, is when the market's going down or the market's going against you, because you might be long a put. Who knows? Then that means the market's going out. But if the market is going against you, which is a better way to say it, and you need to get out now, that's where bid-ask spreads can really hurt you. So I should have defined liquidity. So let me do that right now. But this is what bullet number 1 and number 2 are. Liquid markets have many buyers and sellers with prices changing in small increments. So there's a lot of people that are interested in it. When you go to sell, if somebody sells right ahead of you, there's still another buyer behind it to buy it. And that ends up adding bid-ask spread, or that ends up tightening the bid-ask spread. Now, illiquidity occurs when an asset cannot be quickly sold or exchanged for cash without a significant loss in value. So if you go to sell, and all of a sudden somebody steps in front of you and actually sells ahead of you, and all of a sudden the bid moves, and you're like, what just happened? I'm like, I tried to get out at where the current bid was at. That means that you have illiquid markets. But more important to me is to just look at the bid and ask spread and say, if it's too wide, I'll tell you this, if the stock isn't very liquid, the option contracts are going to be less liquid. That's straightforward. All right. So how to trade smarter? First of all, it goes back to lie down until the urge goes away, or maybe just buy the stock sometimes if that's the underlying that you want to trade, or just focus on stocks that have very liquid markets. You're talking Google, Apple, just stocks in general that are very popular, even Caterpillar. I'm trying to think of things that are a little bit more esoteric in the stock world that you might want to trade options on. You need to have some decent amount of option trading volume, and to go hand in hand with that is a term called open interest. And I'm going to go to my book, Options Playbook, which is a book I authored many years ago, and it has a companion website called optionsplaybook.com. And your homework's going to be to learn about the term open interest and about cashing out your options. And we're just about ready to go there at this point in time. But before I get too far, so this is part one of a two-part series, the top 10 mistakes that option traders should avoid. And you can watch it inside the hub, which is hub.tradier.com. You can also go to, you can also watch it via x.com. You're looking at the Tradier profile or my profile, which is at Brian Overby, at my name. And then we also stream it live through YouTube. So, many different ways. Share it with all your friends and family. Let them know all about it. We like to make them a lively show. So if you have any questions, just toss them in a chat box on any of those platforms, and we'll try to address them. But I encourage you to go to hub.tradier.com and build a sign-on. It's 100% free. And then you have access to all of the great speakers that Tradier sponsors throughout their platform. And it's just there's a plethora of great information. So please do that. Put that on your to-do list going into 2025. All right. So let's switch over now to optionsplaybook.com. And this is my website and my book. I think we're showing it right now. This is the homepage. But if you're thinking about trading options, there's a few pages, especially if you're a beginning option trader, is the first thing I want you to go to is cashing out your options, and kind of understand there's a big misnomer in option trading. A lot of people say, I've heard this quoted before, 80% of all option contracts expire worthless, so you should always just sell options and not buy them. And that's just simply not the case. It doesn't even make sense when you think about the option trading world, because there's liquid marketplaces in general. There's market makers standing ready to take the other side of your trade overall, right? As opposed to unless you're trading something extremely illiquid, which was mistake number 5 that we're talking about. But honestly, bluntly, 70% of all options get closed. They don't even make it to expiration. In other words, let's just talk about a simple buying of a call. I buy a call. I pay, let's say, $3 for the call. The market starts going down, and now it's trading for $150. I sell it. I get out. I don't ride it to expiration. An option contract isn't a hot potato that you pass it to the next person, and when expiration comes, it's got to be in somebody's hand. That means it's going to expire worthless somewhere. No, it's a contract. You bought the contract, somebody sold it to you, it got written, and when you closed it, the contract ceases to exist. And that's where open interest comes in. But 70% of option contracts actually get closed. This is the little pie thing. This comes directly from the Options Clearing Corporation. 20%, or 19, if you want to be more exact, expire worthless, and 11% actually get exercised. And those are the numbers, and they've changed every year. They're all very, very close. For the last 30 years of doing this, they're very, very close as far as the numbers are concerned, year in and year out. So most option contracts, the correct answer is don't make it to expiration. They get bought and opened, and then they get sold and closed, or they get sold to open because you can sell options without owning them, and then they get bought to close. And hence the reason why when you enter an order for an option, you don't just say buy, sell. You say buy to open, or am I buying to close? Or you say sell to open, or am I selling to close? So you have to mark your tickets that way, and the brokerage firm makes you do that. All right. So if you scroll down here, you can click on this little button, and that will take you to open interest. All right. Now, a couple of ways that you can find it is you can use the search tab, and you can type in open interest, and you'll find it that way. or you can get there this way, or you can use the resources tab. All this stuff is in the basics. So very straightforward. But here's the tab on open interest. And this is your homework. Please, they're only a couple of pages, but they go in great detail about cashing out your options and about open interest. And with all that said, that will be it for today's presentation. My name is Brian Overby. I am with you every Monday, Wednesday, and Friday at 11 a.m. Eastern Time for Options Guy TV. We talk about advanced strategies, basic strategies. All questions are welcome. So please stop in the new year, and hopefully we'll see you soon.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.